Hello everyone, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency batch. Okay, so what we have been discussing about, we have been discussing about the Keynesian theory of national income, and this is going to be the last lecture for this particular chapter, and these first two were one of the biggest chapters of economics or finance, right? After that, we are going to have some really small chapters which we will be able to cover up quite quickly. Okay, so nothing to worry as such. So what is the topic? We studied about the two-sector model. We studied about the three-sector model. Now, in this part, we are going to study about the four-sector model. So what is there in the four-sector model? In four-sector model, there are four participants in the economy. The first participant is the household sector. Second is the business sector. These two were already there in the two-sector model also, in the three-sector model also, and now in the four-sector model also. And the third segment is the government sector, which was already there in the three-sector model. Now there is another sector, that is the foreign sector. This is the foreign sector involving the exports and imports, right? So if you talk about the two-sector model, we said that this is a hypothetical model, right? Because the economy cannot exist without the government sector. Now, if you talk about this four-sector model, this is the most realistic model. This is the most practical model, because in every economy, there will be government sector. That is true, that we studied in the three-sector model also. But at the same time, there will be exports and imports also, right? Okay, so this, if you talk about this particular circular flow of income in a four-sector model, this is absolutely similar to what we studied in the three-sector model, with the addition that this rest of the world is the new sector, right? And which will have the communication with the product market, that there will be demand for the product, which we call it as net exports. Now, in this, X is your exports, right? And M is your imports. That what is the net demand of the product? What is the net export is what? The export is that there is a demand for the domestic product in the foreign land. And what is the import? The import is the demand of the foreign product in the domestic land, right? Import is when you are spending, if you talk about exports, exports will add to national income, Why, sir? Why the exports will add to national income? Because you will be earning out of the material that is exported, right? Let's say a person from the USA pays you $1,000 for what? For you are selling your mobile phone, right? You are a mobile phone seller, and he wants that particular mobile phone, so he's paying you $1,000. So what is that? That is, you are going to export that mobile phone and get $1,000. That will be an addition to the national income. But at the same time, if you buy from someone in the USA, you will be paying them. That will be an import. This is a deletion to the national income, right? Deletion to national income. So this is what the addition and deletion means. So net exports, this is with the rest of the world, the interaction of the product market with the rest of the world, that either the people from outside the country will demand the goods, or they will provide the goods as demanded by the economy. Clear? So this is the role of the exports and imports. Now what will happen, sir? He says in a four-sector model, there are three additional flows, namely the exports, imports, and the net capital flow. Net capital flow is net exports, right? The domestic economy trades in goods with the foreign sector through export and import. The export represent the foreign demand for domestic output, and therefore a part of the aggregate demand. Now what will happen, sir? You are manufacturing a product. If someone from outside the country, that is from the foreign land, is demanding your product, what will happen? This will increase your aggregate demand, isn't it? This will increase your aggregate demand. Since the imports are not demand for the domestic goods, we must subtract that from the aggregate demand. Now the imports are what? Imports are not the demand for domestic goods, so it will reduce the demand. Let's say there is a particular headphones you want, right? So either you can buy it from the domestic market, that will add to the aggregate demand, because that is the product which is being manufactured in the domestic territory, right? This is the domestic good which is being demanded. Now if you import that headphone, will that be the domestic demand? No sir, it will reduce that aggregate demand. Clear? That is why we take here the net exports. Exports are the injections in the national income because they increase the national income, while the imports are the leakages or the outflow of the national income. Obviously, that money will flow out of the economy. If you are importing a product, if you are importing something, the money will flow out of the economy. That will act as the leakage, because that money which has flown out of the economy, right, because that money has flown to USA. Now, will that be in the economy of circular flow of this India? No, sir. Right? That will not be existent in the circular flow of India. So that is a leakage from the national economy. So equilibrium in the four sector model is given as y is equal to c plus I plus g plus x minus m. This is basically your aggregate demand, right? This is how you will get the level here. Now this is the income level, this is the aggregate expenditure. Now this aggregate expenditure is the function of consumption plus investment plus government plus x minus m. This x minus m is your net exports. This is your net exports. This is the income line, right? And here on the other hand, on the other side, what will you have? The savings plus the government will ask for the taxes. In savings is equal to investment, taxes is equal to government expenditure, and here you will have the imports and the exports, right? What is equilibrium? Now we have studied about equilibrium. Sir, now in the four sector model, when we say equilibrium, let's talk about the equilibrium in four sector model. Equilibrium in four sector model. How that equilibrium will be? See, one thing we know. What is equilibrium? Equilibrium is attained when the aggregate demand is equal to aggregate supply, right? Aggregate demand is equal to aggregate supply. Now what is being demanded? Either the consumption plus investment plus the government expenditure plus, he says, the exports, right? And what is being supplied? Supplied means the consumption plus the savings plus the taxes plus the imports. M is your imports. Now we know that C is a constant function of income. So we will eliminate this C. What is there now? What is left with is I plus G plus X is equal to S plus T plus M. Now what is the meaning of this? Try to understand. Sir, the firms which are manufacturing within the domestic territory of the country, while checking out the disposable income of the people, that what is the disposable income that people have in hand on which they are ready to do the expenditure, the firms will have a look at what the people are saving, what the people are paying in the form of taxes, and what the people are paying as imports. Why? Because they will be manufacturing accordingly. Because savings is what? The leakages. They are not going to spend that money. Taxes is what? Paid to the government. They are not going to pay to the firms. And imports is what? Import is the money flowing out of the economy. Again, that money is not going to the firms, right? So that is why the supply is dependent upon these three things. Demand, sir, as we discussed, that C is a function of income. So aggregate demand will increase only if there is increase in the investment expenditure or the government expenditure or the exports, right? In another language, if you want to understand, whatever you will save, you will invest. Whatever the taxes you will pay, out of those taxes, the government will be doing the expenditure, and ultimately the imports and the exports, this is your net exports, the net capital flow. Clear? Net capital flow, this can be written as I plus G plus X minus M is equal to S plus T. This is how it is written. Understood? So basically what is there? This is your leakage. This complete section is your leakage, and these are the injections in economy, right? And whenever the injections and the leakages match, there is what? equilibrium. So that is what the equilibrium here is in the four sector model, right? So this is what is meant here. The x-axis represent the income while the y-axis represent the C plus I plus G plus X minus M. The investment, government expenditure and net exports are exogenously determined. That is determined, not dependent upon the income that is outside the model. The equilibrium level of income is determined at point E, where C plus I, this point, E point, right? Where C plus I plus G plus X minus M line intersects the 45-degree income line. At this level of national income, the leakages from the circular flow are equal to the injections, because you are doing savings, you are investing that money. The government is taking the taxes, the government using those taxes for the expenditure, right? And imports related to obviously the exports. Then as the exports are injections and the imports are leakages, the increase in the level of export increases the level of national income, which I have already discussed. That export is what? The export leads to the addition in the national income, whereas the imports lead to the deletion from the national income. While the increase in the level of import reduces the national income, right? So this is your four sector model. Now let's see further. He says impact of higher imports on the export. If the imports are more than the exports, then what will happen, sir? Let's try to understand. This is C plus I. C plus I is with the investment, it will increase. Aggregate demand will increase. Now this is C plus I plus G. This is the three sector model, right? This is the three sector model. This is the two sector model. Now with this part, what will happen, sir? He says due to the presence of exports, the aggregate demand will increase. No doubt about it, right? Earlier, this was the equilibrium level. At three sector model, when the government expenditure is there, with the government expenditure, the income is increasing, right? The income is increasing, the government expenditure is there, and this is your equilibrium level. Now what happens? He says when the exports are there, the aggregate demand is increasing. But after that, what will happen? Now, along with exports, due to the presence of imports, that is this M, what will happen, sir? This aggregate demand will not keep on increasing. It will fall, and this equilibrium level will now fall from F to E point. That is, your income will reduce. Obviously, why the income is reducing? Due to the presence of leakages. Due to the presence of leakages, that is, this part will leak from the economy. It will no more be in the circular flow of income. It will act as the leakages, reducing the income from Y1 to Y and the equilibrium level from F to E. That is what is here when the imports are more than your exports. So we say when we consider the economy without the foreign sector, that is aggregate demand, link is given by C plus I plus G, the level of equilibrium is at point F. However, if we consider the foreign sector where the imports exceed the exports, aggregate demand will increase because of the export. That is, the net exports are negative. We obtain the demand line this, which lies below the C plus I plus G line, and the equilibrium level falls to point E. The income also falls from Y1 to Y because of the presence of this leakages. In a condition where the exports are higher than the imports, the C plus I plus G plus X minus M line would lie above this, resulting in the higher level of national income. If the exports are higher, then what will happen? Then this line will go like this. If the exports are positive, if the exports are more than the imports, then this will be the line C plus I plus G plus X minus M. But when will this happen? This will if exports are more than imports. If exports are more than imports, then this income level will increase, shift here, let's say Y2, and your equilibrium level will also increase here. Your equilibrium level will go above F. Clear? So this was the four sector model, the impact of higher imports and how the equilibrium is being determined when the imports are higher than exports or when the exports are higher than imports. Now the last topic of this is the multiplier in the four sector model. Now what is a multiplier? Multiplier, we say that if we are doing the investment, by investing, what is the amount of national income that will be increased, right? The number of times. Now it will be increasing only if there is the MPC, that is the marginal propensity to consume. So we studied about the inverse relationship between the multiplier and the marginal propensity to save. If the people are going to save, they are not investing anything, then how can we say that that money will multiply? That money is not going to multiply. If you are earning 100 rupees, you are keeping 20 rupees in your pocket and you are spending 80 rupees, right? So money will multiply by 80 rupees only. Those 20 rupees are not going to multiply if they are in your pocket only. So the same thing, what happens, sir? Inverse relationship. We studied about the inverse relationship between investment and savings. Because the savings are the leakages, we can say there is an inverse relationship between the investment and the leakages. Now, in the four sector model also, there is a leakage. What is the leakage? The leakage is the imports. So we can say there is inverse relationship between the investment multiplier and what? The imports, which this calls it as the propensity to import. That what is that? Marginal propensity to import, like it is marginal propensity to consume. So this multiplier is defined as 1 divided by MPS, that is one leakage, plus MPV, that is the marginal propensity to import. That if you are 100 rupees, how much of that you will be spending on the import and how much of that will be there in the export part. Clear? So that is known as MPV, which is also defined as the small v. Now MPS is what? MPS is 1 minus MPC, 1 minus MPC plus MPV. What is MPC? We studied about it. 1 divided by 1 minus B plus MPV is written as V. This is how the multiplier is determined in the four sector model, right? Rise in imports per unit of the income creates additional leakage from the circular flow, thus reducing the value of multiplier. Basically, what is this MPV or V? This is the change in imports due to change in income. Due to change in income, that if your income increases, how much of that income you are ready to spend on the imports. The exact opposite effects are observed in case of increase in the export, which increases the value of multiplier. In other words, the increase in the export demand has the expansionary effects on the equilibrium, while the imports result in the contractionary effects, which we have already studied about. Clear? That with the exports, your national income is going to increase, and with the imports, your national income is going to decrease. That is what is expansionary and the contractionary effect. So with this, all the topics of this particular chapter, that is the Keynesian theory of national income, we are done with this. Are there any practical problems? Yes, there are practical problems which you people will do. I'll tell you how to do it. Very simple as we have been doing. Let's do one practical problem. Illustration number 17. Let's do this. He says the consumption function is C is equal to 40 plus 0.8 YD. What is YD? That is a disposable income. Tax, T is what? T is the tax, 0.1 is the tax rate of the total income. I is equal to 60, G, that is the government expenditure, is 40 crores, X, that is exports, is 58, and M is 0.05Y. Now what does it mean? This 0.05 is the MPV, that is the marginal propensity to import out of the total income. Right, that out of the total income, what is the percentage that you are ready to spend on the imports? He says find out the equilibrium level of income, the net exports if the exports were to increase by 6.25. Now what is the total income function? That Y is equal to, what is the total income or the aggregate demand function? That is C plus I plus G plus X minus M. Now, what is the value of C that is given to you? That is 40 plus 0.8 YD plus what is the investment that is given to you? 60 plus government expenditure is 40 plus what are the exports? 58 plus minus what are the imports? 0.05 Y. Right? Now, try to understand what is YD here. What is the disposable income? So, total income that is earned minus the taxes out of it. So we can write it as 40 plus 0.8. Total income is Y. Out of that, you will be paying taxes. That is 0.01 Y, right? Plus 100 plus 58 minus 0.05 Y. Now, from this, you will calculate the value of Y, which will come out to 600 crores, right? Once the value of Y is calculated, you can calculate the net exports. What is net export? That is X minus M, right? What is net export? That is X minus M. That is 58 minus 0.05 Y. What is the value of Y? Y is calculated as 600. So the net export here is 28. Now, if exports increase by 6.25, then the exports will be 64.25. Then accordingly, you can calculate the value of Y. He says the net export, if the export were to increase by 6.25. So he has calculated the value of Y again. Because the exports have changed, the total income will obviously change, because the increase in exports will increase your total income, right? So we have calculated the total income again. That comes to 619.697. Then the imports will be 30.98 and the net export will be 33.27 crores. Thus, there is a surplus in the trade as the net exports are positive. So a very simple question. Basically, in this whole chapter, you have to remember few things. What? Sir, Y is equal to C plus I plus G plus X minus M. Now, if you talk about the two-sector model, in the two-sector model, there are only these two things. In the three-sector model, the government expenditure is added, and in the four-sector model, what is happening? In the four-sector model, you have the exports along with this, right? So this is your four-sector model. Then we say that C is a function of A plus BYD. BYD. What is B? B is the marginal propensity to consume. That out of the total disposable income, how much you are ready to consume and how much you are ready to save, right? You will substitute the value of C here. Plus, now if you talk about YD, that is the disposable income. If you talk about the disposable income, what is there in the disposable income, sir? In the two-sector model, Y is equal to YD, right? In the three-sector model, there are different scenarios that YD is equal to Y minus taxes plus transfer payments. Basically, this is the thing. Now, in the four-sector model, what is your YD? Again, here the transfer payments can be there, but this will remain the same, plus the transfer payments, because exports and imports we are taking separately. Disposable income is what? Total income minus taxes plus transfer payments, if any. Clear? This is how it is going to be the basic scenario for solving the practical problems, right? C function is there. This is the aggregate demand function that we have studied about. So with this, we complete this chapter. Sir, there are some numericals. This illustration number 18, you can do it on your own very, very easily, right? Very easily. The multiplier also we have discussed. Conclusion is there. Everything ends. Now, the practical questions at the back, application oriented questions. This is your homework. You people have to try it. If you have understood whatever we have discussed, you can easily attempt whatever is there. Just 7 questions are there. The solutions are there. In case you find any difficulty, please feel free to contact us on our email ID, that is ksjteaching@gmail.com, right? Otherwise, I believe if you have gone through the chapter very thoroughly, very seriously, and if you have all the books, the economics books are there with you, right? All the books with you, then these 7 questions are going to be a cakewalk. That this is not going to be a difficult part, right? And with the application questions, with the illustrations, we have already covered that, right? Okay, so with this, we complete this chapter, our second chapter, that is the Keynesian theory of national income. Now, in the next lecture, we are going to start with our third topic, third chapter, that is fiscal functions and overview. A very, very simple chapters. We will be able to quickly cover all these chapters because these are comparatively simpler, right? These two first chapters are very important from the practical point of view also. 5 marks question, practical question from the national income, and from this Keynesian theory also, you can definitely expect a question in the examination. Either it can be a practical question or it can be a theoretical question also on the equilibrium level or on the circular flow of income. Any kind of question can be asked in the examination, right? So get ready for the new chapter in the next lecture. So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.